Hey everybody, Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania. And we're coming to you a little bit later in the month with usually it's called the first of the month update, but this is more a mid-month update that we're doing because we want to cover a couple of things as far as what's happening in the markets and what we think is going to go on next year in 2025. So right now, obviously in everybody's minds, Santa Claus has come to town. One of the things that's happened after the November election is basically there's been a lot of euphoria, and you're going to hear me say that word many times in this presentation because that's where we're at. Santa Claus has come to town. The markets are up sharply since the November election. And with only a week or two to go before the end of the year, let's see what's going to happen. So we ended up having the S&P rally to new all-time highs. We are now knocking on 6,100 on the S&P 500. But recently in the last 7 or 8 days, we've seen Dow stocks or value stocks actually sell off. Why once again, the Magnificent Seven stocks, Amazon, Apple, Netflix, Nvidia, Google, Microsoft, and Tesla continue on to make new highs, which is again very, very unusual because very similar to what happened in 23 and the first half of 24, a small group of stocks were driving the averages. And then this summer, we saw the averages kind of broaden out, small mid caps started to participate. We are now back to a very extended period where a small number of stocks are driving the averages higher. So again, we want to talk about the euphoria that's out there. Obviously, Trump has talked about what's going on in the crypto space. There's record flows into the crypto funds nowadays. I'm getting people calling me up who never want to take risk in their life, wanting to get into crypto at this particular moment. One of the ways that we've traded crypto in the past is that when it's down big, that's when you buy it. And when it's up big, that's when you sell it. And right now, obviously, crypto is up big for the year. The other thing that we've seen happen is there are record flows into exchange traded funds. Again, you can see that 2024 investors are just plowing money into the U.S. equity market, and they're doing it with ETFs. And they're really focused on U.S. large cap equity funds. Again, I told you we saw some broadening out in the small and mid cap where we've been pounding the table about valuation in that area. But you can see that investors are not paying heed. They are literally stampeding into the stock market. So one of the things I try to tell people is that emotion plays a large part in investing. And if you remember back, it wasn't that long ago, February and March of 2020, when the stock market was down sharply because we'd shut our country down and everybody had to wear masks, we saw the S&P 500 down 32.5% in 2.5 weeks. People could not get out of the stock market fast enough. Well, from a psychological standpoint, our risk indicators were compressed. That was the time to buy. And sure enough, if an investor went all in at that time, obviously they've had very good investment results. This is exactly the opposite end of the spectrum where we're seeing investors chase fewer and fewer stocks, crowding into a trade that we think obviously isn't going to last much longer. Now, you can never tell the top in a market, and you can lose a lot of money trying to pick a top in the stock market. But what we're saying now, we've been saying it for the last couple of months, caution is warranted. Now is not the time to go all in. We're not saying sell all of your equity positions, but take a look at extended equity positions. Don't forget to rebalance your accounts from time to time. Now, the other thing that's happening is that the Fed has been actually cutting interest rates. And back in the summertime when the 10-year Treasury was at 3.6% and the Fed did a 50 basis point or 0.5% rate cut, we saw interest rates actually float back up to 4.3, 4.4. And you can see most recently right around 4.5%. We think that this is a lot of value out there. We think that bond investors and anybody with a lot of cash on the sideline should be buying some type of intermediate to longer term government or corporate bond fund or ETF. We have a couple of favorites that we can tell you about. But the other thing that's happening is that the Fed is caught between a rock and a hard place. Treasury yields on the short end, you're getting T-bills and bank CDs at 4.5%. Now that's down from this summer's high of 5.25 to 5.35%, but still it's a very good place to be. Now, A preview for 2025 is that we actually think there's a very high probability that bonds could outperform stocks. That hasn't happened in over 7 years. We think it's about time. And what that means is that the stock market has a very high probability of being flat for 2025. And the bond market could end up making 5, 6, 7%. We really think that the Fed is eventually got to lower short-term interest rates, because if any of you have been reading the news, you can see that they've been talking about that the interest on the national debt is now $1 trillion. One of the easiest ways to get the interest on the national debt down is to obviously lower interest rates. And we think that's going to be a big story sometime in mid-2025. So the post-election rush into stocks has caused equity valuations to go to an extreme level. Again, we are not looking for a huge correction or a big sell-off, but one of the things that can happen is that stock markets can trade sideways for a very long time until valuation levels normalize. You know, the yield curve is flat. We're not saying buy really super long-term bonds, but you have to start moving out somewhere into the 5 to 7 year, what they call duration level. But again, short-term bonds are still offering a lot of attractiveness, but be prepared that sometime by midsummer, you could see short-term rates a full % lower than where they are right now. So if you lock in some longer-term rates on longer-term bonds, you're going to be able to protect yourself from that standpoint. The other thing you want to do is consider out-of-favor asset classes. Wayne Gretzky was one of the greatest hockey players of all times. And when Wayne Gretzky was interviewed, they asked him, hey, why are you such a great hockey player? And he's like, because I skate to where the puck is going, not to where the puck has been. So what I'm saying is that one of the areas that are really underinvested right now are broad commodity funds. There's a couple of very good ETFs that we're using for our clients. And these broad commodity funds literally are a basket of commodities. Now, why would you want a broad commodity fund into your portfolio? Because it acts as a portfolio diversifier. In 2022, when the stock market was down sharply and the bond market was down sharply, commodity funds returned anywhere from 20 to 35%. So if you had some commodity funds in your portfolio, maybe 5 or 10% exposure, it helped to alleviate, obviously, a negative return in your portfolio for 2022. Right now, no one's paying attention to these commodity funds. The flows have been very poor the last 12 to 14 months because everybody's chasing cryptocurrencies and obviously the Magnificent Seven stocks. And we think that in 2025, at some point, commodity funds could show a lot of good return going into next year. So that's our mid-month update. We hope you enjoyed it. We would like to really thank all of our clients very profusely. We really enjoyed. This was a good year. Everybody made money. It was a very pleasant year where it was a lot of drama. But now going into the later part of the year, everybody's looking at their portfolios. They're happy. We're happy. And we really want to thank you for being clients of Engelbert Financial Advisors. And we look forward to working with you in 2025.